AMD didn't just beat expectations this quarter, it shattered them. At a time when the entire market is searching for real winners in the AI boom, Advanced Micro Devices just delivered a statement performance, posting $10.3 billion in revenue and proving it's not just riding the wave but actively taking market share in one of the most competitive industries in the world. The real question now isn't whether AMD is benefiting from AI, it's how far this momentum can actually go. Heading into this quarter, AMD was already riding a powerful narrative. The explosion in AI infrastructure demand, particularly for data center GPUs and high-performance CPUs, has fundamentally reshaped the semiconductor landscape. Hyperscalers, cloud providers, and enterprise customers are all racing to build out compute capacity, and AMD has been positioning itself aggressively to capture that demand, especially with its 𝗣𝗟𝗨𝗦 server CPUs and Instinct AI accelerators. So the big question going into Q1 2026 was simple. Is AMD actually converting this AI momentum into financial performance? And based on what we're seeing in this report, the answer is a very clear yes. Let's start with the headline numbers. AMD reported first quarter revenue of $10.3 billion. That's up 38% year over year. Now pause there for a second, that's not incremental growth, that is acceleration at scale. For a company already operating at this revenue level, nearly 40% growth is extremely significant. Sequentially, revenue was essentially flat compared to the previous quarter, which came in at roughly the same level. And in my view, that's actually not a negative signal. When you're coming off a strong Q4 and maintaining that level into Q1, traditionally a softer quarter seasonally, that suggests underlying demand is very strong. Now moving down the income statement, gross profit came in at $5.4 billion, representing a gross margin of 53%. That's up 3 percentage points year over year. On a non-GAAP basis, gross margin was even higher at 55%. This is critical, because in semiconductors, margin expansion is one of the clearest indicators of product mix improvement. And what this tells me is that AMD is selling more high-value products, specifically in data center and AI. Now let's talk operating income. Operating income came in at $1.5 billion, up 83% year over year. That's a massive jump. Operating margin expanded to 14% compared to 11% a year ago. On a non-GAAP basis, operating income was $2.5 billion, with an operating margin of 25%. So what does this tell us? This tells us AMD is not just growing revenue, it's scaling profitability. And that's a key distinction, because a lot of companies can grow revenue in a hot market, but very few can expand margins at the same time. Now let's go further down. Net income came in at $1.4 billion, up 95% year over year. And diluted earnings per share came in at 84 cents, up 91% compared to 44 cents a year ago. On a non-GAAP basis, earnings per share was $1.37, up 43% year over year. So across the board, revenue, operating income, net income, EPS, everything is moving in the right direction, and not just slightly, but aggressively. Now here's where things get even more interesting. We need to break down where this growth is actually coming from, because not all revenue is created equal. AMD operates across three main segments: data center, client and gaming, and embedded. Let's start with the data center segment, because this is the engine of the entire story right now. Data center revenue came in at $5.8 billion. That's up 57% year over year. That is extraordinary, and it confirms exactly what management is signaling. AI infrastructure demand is driving the business. This growth is being fueled by strong demand for 𝗣𝗟𝗨𝗦 processors and the continued ramp of Instinct GPUs. These are the products being deployed in large-scale AI clusters, cloud environments, and enterprise infrastructure. In my opinion, this is the single most important takeaway from the entire report. AMD is no longer just a CPU company competing in PCs. It is now deeply embedded in the AI compute stack, and that changes the long-term valuation framework completely. Now let's move to client and gaming. This segment generated $3.6 billion in revenue, up 23% year over year. Breaking that down further, client revenue was $2.9 billion, up 26% year over year. This was driven by strong demand for Ryzen processors and continued market share gains. Gaming revenue came in at $720 million, up 11% year over year. Now here's my take on this segment. It's solid, but it's no longer the primary growth driver, and that's actually a good thing, because historically, AMD's revenue was heavily tied to the PC cycle, which is cyclical and less predictable. Now, the center of gravity is shifting toward data center and AI, which is structurally higher growth and higher margin. Finally, the embedded segment. Revenue here was $873 million, up 6% year over year. This is more of a steady, diversified business, less volatile, but also less explosive in terms of growth. So when you step back and look at the segment mix, you can clearly see the transformation happening inside AMD. Data center is now the dominant force, and it's growing significantly faster than the rest of the business. Now let's talk about expenses, because growth is only valuable if it's efficient. Operating expenses came in at $3.9 billion, up 34% year over year. That's a meaningful increase. But here's the key. Revenue grew faster than expenses. That's why operating income expanded so significantly. On a non-GAAP basis, operating expenses were $3.1 billion, representing about 31% of revenue. So AMD is investing heavily, but still maintaining operating leverage. That's exactly what you want to see in a company scaling into a major growth cycle. Now let's shift into one of the most important sections of any earnings report: cash flow. Because at the end of the day, earnings can be influenced by accounting, but cash flow tells you what's actually happening in the business. AMD generated $2.9 billion in operating cash flow in the quarter. That's up dramatically from $939 million a year ago. And here's the standout number: free cash flow. Free cash flow came in at $2.5 billion. That's more than triple the $727 million generated in the same quarter last year. And the free cash flow margin was 25%. That is a very strong number, especially for a semiconductor company investing heavily in growth. In my view, this is one of the clearest indicators that AMD's business model is reaching a new level of maturity. They are not just growing, they are generating substantial cash while doing it. And that gives them flexibility. Flexibility to invest, to innovate, to compete, and to return capital if needed. Now, before we move further into the balance sheet and guidance in part 2, let's pause and interpret what all of this actually means, because numbers alone don't tell the full story. Here's my perspective. AMD is executing extremely well in the current AI-driven environment. The company is benefiting from a massive structural tailwind, but more importantly, it is capturing that tailwind with the right products at the right time. The data center segment is doing exactly what it needs to do: drive high-margin, high-growth revenue. Margins are expanding, cash flow is accelerating, and management is signaling confidence in continued demand. However, and this is important, we are also seeing some sequential softness in certain metrics like operating income and margins compared to the previous quarter. That doesn't negate the strength, but it does suggest that scaling this business comes with complexity, and that's something we'll need to monitor closely going forward. We've already established that advanced micro devices delivered strong revenue growth, expanding margins, and explosive free cash flow. But the next question is this: how strong is the foundation underneath all of that growth? Because growth without a solid balance sheet can unravel very quickly, especially in a capital-intensive industry like semiconductors. So let's go deeper. Starting with liquidity. AMD ended the quarter with $5.5 billion in cash and cash equivalents. On top of that, the company held $6.7 billion in short-term investments. That brings total liquid assets, cash plus short-term investments, to roughly $12.3 billion. That is a very strong liquidity position, and it matters more than ever right now, because the AI arms race is not cheap. Companies are spending aggressively on R&D, supply chain commitments, and partnerships. Having over $12 billion in highly liquid resources gives AMD the ability to continue investing aggressively without putting pressure on its financial stability. Now let's look at the broader asset base. Total assets came in at $79.6 billion, up from $76.9 billion in the prior quarter. So the balance sheet is expanding, which is expected in a high-growth phase. Looking specifically at working capital components, accounts receivable came in at $6 billion, slightly down from the previous quarter. That suggests collections are stable and not deteriorating, which is a good sign. Inventories were $8 billion, slightly up from $7.9 billion. Now, inventory is something I always pay attention to in semiconductor companies, because rising inventory can mean two very different things. Either demand is strong and the company is building ahead of it, or demand is weakening and products are not moving. In AMD's case, given the strong revenue growth, especially in data center, it's far more likely that this inventory build is strategic. They're positioning themselves to meet continued demand, particularly in AI infrastructure. Now let's shift to liabilities. Total current liabilities came in at $10.5 billion. Long-term debt sits at $2.3 billion, with total debt at approximately $3.2 billion. Now compare that to over $12 billion in liquid assets. This is what we call a net cash position, and it's a powerful one. AMD is not financially constrained. In fact, they are in a position of strength, where they can fund growth internally without relying heavily on external financing. From a risk perspective, that significantly reduces balance sheet vulnerability. Now let's talk about equity. Stockholders' equity came in at $64.4 billion, up from $62.9 billion. Retained earnings increased to $8.1 billion from $6.7 billion. That increase directly reflects the strong profitability we saw in the quarter. So overall, the balance sheet tells a very clear story. Strong liquidity, manageable debt, growing equity, and a solid foundation to support continued expansion. Before we go any further, make sure you hit that like button, subscribe to the channel, and share this video if you find value in these deep dive earnings analyses. Now let's move into capital allocation, because this is where management decisions really start to matter. During the quarter, AMD repurchased approximately $221 million worth of common stock. In addition, they repurchased another $134 million related to tax withholding on employee equity plans. So in total, over $350 million went toward share repurchases. Now here's my take on this. It's a balanced approach. They're not overcommitting to buybacks, which I think is the right move. Because right now, the priority should be investing in growth, especially with AI demand accelerating. But at the same time, they're still returning some capital to shareholders. It's disciplined capital allocation, not overly aggressive, not overly conservative. Now let's go back to cash flow for a moment, but from a strategic lens. Operating cash flow came in at $2.9 billion. Capital expenditures were $389 million, which leads us to free cash flow of $2.5 billion. Now here's why this matters. Free cash flow is what ultimately funds everything: R&D, acquisitions, partnerships, and shareholder returns. And AMD is generating a substantial amount of it. In fact, free cash flow more than tripled year over year. That level of acceleration is not just impressive, it's transformative. It means AMD has entered a phase where it can self-fund its expansion in the AI market, and that is a major competitive advantage. Now let's talk about something equally important: guidance. Because the market doesn't just care about what happened, it cares about what happens next. For the second quarter of 2026, AMD expects revenue to be approximately $11.2 billion, plus or minus $300 million. At the midpoint, that represents approximately 46% year-over-year growth, and about 9% sequential growth. Now that sequential growth number is key, because it indicates that demand is not slowing down, it's accelerating. And remember, this is coming after a quarter where revenue was already at record levels. Now let's look at margins. AMD expects non-GAAP gross margin to be approximately 56% in Q2. That's an increase from 55% in Q1. So not only is revenue expected to grow, but margins are expected to expand as well. That combination is extremely powerful, because it implies that the mix is continuing to shift toward higher value products, most likely data center and AI. Now let's connect this to management commentary. CEO Lisa Su highlighted accelerating demand for AI infrastructure, specifically driven by inferencing and what she refers to as agentic AI. This is important, because it suggests that AI demand is not just coming from training large models, but increasingly from deploying and running them at scale. That expands the total addressable market significantly. She also mentioned that server growth is expected to accelerate meaningfully as supply scales to meet demand. That tells us one thing very clearly: demand is not the constraint, supply is, and when supply becomes the limiting factor, companies that can scale production effectively tend to win. Now let's talk about some of the strategic developments mentioned in the report, because these are not just headlines, they are signals of where the business is going. AMD highlighted expanded collaborations with major cloud providers including AWS, Google Cloud, Microsoft Azure, and Tencent. These are not small customers. These are the backbone of global cloud infrastructure, and increased adoption across these platforms suggests AMD is gaining share in one of the most important markets in tech. There's also a major deployment initiative with Meta involving AMD Instinct GPUs, potentially scaling up to 6 gigawatts of compute capacity. That is massive, and in my view, partnerships like this are what validate AMD's position in the AI ecosystem. They are no longer an alternative, they are becoming a core supplier. Now let's take a step back and interpret everything we've covered so far. Here's the big picture. AMD is firing on multiple cylinders, revenue is growing rapidly, margins are expanding, cash flow is accelerating, the balance sheet is strong, and guidance is pointing to continued momentum. But here's where I want to introduce a layer of realism, because no investment is without risk. Even in a strong report like this, there are areas investors need to watch carefully. First, operating expenses. They are rising significantly. While revenue is currently outpacing expenses, that dynamic needs to be maintained. If expense growth starts to outpace revenue growth, margins could come under pressure. Second, sequential declines in some profitability metrics. Operating income and margins were lower compared to the previous quarter. Now this could be due to investment timing or product cycles, but it's something to monitor. Third, industry risks. The semiconductor industry is inherently cyclical, and AMD is still exposed to broader macroeconomic conditions, supply chain constraints, and competitive pressures. Fourth, execution risk. Scaling AI infrastructure is complex. It requires coordination across manufacturing, supply chain, and customer deployment. Any disruptions could impact growth. So while the current trajectory is strong, it is not guaranteed. Alright, now we bring everything together. We've gone through the revenue, the margins, the segment performance, the cash flow, the balance sheet, and the forward guidance from Advanced Micro Devices. At this point, the question is no longer what happened. The real question is, what does all of this mean, and what should investors actually do with this information? So let's break this down the way a serious investor would, by building both the bullish case and the bearish case, grounded strictly in the data we've analyzed. Let's start with the bullish case, because there is a lot to like in this report. First, and most importantly, the growth is real, and it's accelerating. Revenue came in at $10.3 billion, up 38% year over year. That alone is impressive. But when you combine that with 57% growth in the data center segment, you start to see something bigger unfolding. This is not just cyclical recovery. This is structural growth, driven by AI, and in my view that distinction matters more than anything else. Because structural growth tends to be more durable, more predictable, and more valuable over time. Second, margin expansion confirms quality of growth. Gross margin increased to 53%, and non-GAAP gross margin hit 55%. Operating margins expanded year over year as well. This tells us AMD is not just selling more, it's selling better. Higher value products, higher margin segments. And that is exactly what you want to see when a company transitions into a new growth phase. Third, profitability is scaling aggressively. Operating income was up 83%, net income was up 95%. Earnings per share nearly doubled year over year. These are not incremental improvements, these are step function changes. And when profitability grows faster than revenue, it signals operating leverage is kicking in. Fourth, free cash flow is exploding. $2.5 billion in free cash flow, more than triple last year's number. That is one of the strongest signals in the entire report, because cash flow is what ultimately drives valuation, and AMD is now generating serious amounts of it. Fifth, the balance sheet is extremely strong, over $12 billion in cash and short-term investments, relatively low debt, growing equity. This gives AMD flexibility, and in a competitive industry, flexibility is power. Sixth, guidance is strong and reinforces momentum. Second quarter revenue expected at around $11.2 billion. That implies continued growth, both year over year and sequentially, and margins are expected to expand further. So the company is not just reporting strong results, it's projecting continued strength. And finally, strategic positioning in AI is becoming undeniable. Partnerships with major cloud providers, large-scale GPU deployments, product momentum across 𝗣𝗟𝗡 CPUs and Instinct accelerators. All of this points to one conclusion. AMD is becoming a core infrastructure provider in the AI economy, not a niche player, not a secondary option, a core player. Now let's shift to the bearish case. Because no matter how strong a report looks, you need to understand the risks. First, operating expenses are rising significantly, up 34% year over year on a GAAP basis. Now yes, revenue is outpacing expenses, for now. But if that balance shifts, margin expansion could stall. And in high-growth environments, cost discipline becomes increasingly important. Second, sequential softness in profitability. Operating income and operating margins declined compared to the previous quarter. Now this doesn't invalidate the overall trend, but it does suggest that growth is not perfectly linear. There are fluctuations, and investors need to be prepared for that. Third, inventory levels are increasing. Now, as we discussed, this is likely strategic given strong demand, but inventory always carries risk. If demand slows unexpectedly, elevated inventory can quickly become a problem. Fourth, industry cyclicality and macro exposure. Semiconductors are not immune to economic cycles. If enterprise spending slows, or if cloud providers pull back, even temporarily, it can impact growth. Fifth, execution risk in AI scaling. This is a big one. Scaling AI infrastructure is not just about demand, it's about execution, supply chain coordination, manufacturing yields, component availability. Any disruption in these areas could affect AMD's ability to deliver. And finally, intense competition. While not explicitly quantified in the report, it is an underlying reality. The AI semiconductor space is one of the most competitive markets in the world. Maintaining momentum will require continuous innovation and flawless execution. Now let's move into what I consider one of the most valuable parts of this analysis. What should investors be watching next quarter? Because earnings reports are not isolated events, they are part of a trajectory. Here are the key signals to monitor. First, data center growth sustainability. Can AMD continue delivering strong double-digit or even hyper growth in this segment? This is the core driver of the entire story. Second, gross margin trajectory. If margins continue to expand, it confirms improving product mix and pricing power. If they stall or decline, that could signal competitive pressure or cost challenges. Third, free cash flow consistency. Was this quarter an outlier or the beginning of a new baseline? Sustained high free cash flow would significantly strengthen the investment case. Fourth, operating expense discipline. Are expenses growing in line with revenue or starting to outpace it? This will directly impact profitability. Fifth, guidance execution. Can AMD deliver on the $11.2 billion revenue target for Q2? Meeting or exceeding guidance will reinforce credibility. And finally, continued AI deployment momentum. New partnerships, expanded deployments, and product adoption will be critical indicators of long-term positioning. Now it's time to answer the question every investor is waiting for. How good was this earnings report, really? On a scale of 1 to 10, I'm giving this quarter a 9 out of 10. And here's why. The company delivered strong revenue growth, expanded margins, accelerated profitability, generated record free cash flow, maintained a strong balance sheet, and provided confident forward guidance. The only reason this is not a perfect 10 is due to rising expenses, some sequential softness, and the inherent risks associated with scaling in a highly competitive and capital-intensive environment. But overall, this is a high-quality earnings report. Now let's get to the final call. Buy, hold, or sell. Based strictly on the data presented in this report, this is a buy, and here's the reasoning. AMD is demonstrating strong execution in one of the most important technological shifts of our time, AI infrastructure. It is growing rapidly, improving profitability, generating significant cash flow, and strengthening its competitive position. At the same time, it maintains a solid financial foundation with low debt and high liquidity. Now, of course, valuation, market conditions, and broader portfolio strategy all matter, but based purely on operational performance and forward momentum, this is a company that is performing at a very high level. So to wrap this up, AMD is no longer just a turnaround story. It is now a growth engine, driven by AI, supported by strong execution, and backed by real financial performance. The next few quarters will be critical, but right now, the trajectory is clearly upward. If you enjoyed the video, share your thoughts in the comments and subscribe to the YouTube channel so you don't miss out on the next important analysis update. Thanks for watching, and I'll see you in the next one.